Hey, hi guys, hope you're well. So yeah, finally I can teach you guys the liquidity rate strategy. So this is going to be the most complex strategy. So we started with the most simple one, that is the 1-to-2 ratio silver bullet strategy. Then we have the Nasdaq strategy. That's a bit more complicated, but I mean you can simplify it for yourself. And then we have the liquidity rate strategy. Now, I would recommend trading this on the 1 minute or taking entries on the 1 minute, just because we want a bigger risk reward with these trades. The heat trade might not be as good as the others, but you will take, let's say, more break evens than wins and losses. So you'll still save your capital, but it doesn't. But the heat trade, the actual 1-to-5, 1-to-10 trades that you're going to capture might be less. You might capture one a week or two a week, or not even. You might not even capture anything for the week. So, yeah, so you need to decide what level you are on and what strategy you are ready to trade, and then you can take it from there. Okay, so with the strategy, I'm going to keep it short and simple, as simple as possible, but obviously you'll need to go through the course to understand certain principles and certain key parts to actually understand what I'm talking about here. All right, so with the liquidity rate strategy, what we want to do is the basic fundamental idea is we want to identify liquidity pockets or liquidity pools. And in order to identify that, we're going to use higher time frame and low time frame session ranges, but the whole idea is that if the market trends, this is just a basic example, as soon as it goes above or below a certain liquidity pool. So let's say it's trending to the upwards. We have obviously our retracements, and this is going to be on a higher time frame. On a lower time frame, there's sessions. So we might be retracing here, and then there's a London session or there's an Asian session, and normally Asian session tends to range a bit. So let's just say it ranges in the Asian session. What tends to happen is they are building up liquidity above and below. But the whole principle of this thing is we want to, if our bias is bullish on the higher time frame, we want to go into a London session, understanding where the session range is for Asia. So let's say the session range now is that's the high of the Asian range, and this is the low of the Asian range. We want to understand then that if we are bullish, there's liquidity below before we're going to head up. It's very unlikely that the market will keep the low intact and just push up to create a new high. So what we want to wait for is that push into the liquidity and then a clear displacement or breaker structure to the upside, and then get our entry to the upside after liquidity has been taken out. Okay, and normally you'll also see that normally these pushes and stuff also aligns with higher time frame order blocks and fair value gaps and stuff like that. So that's the whole idea of it. So we want to take our entries on the liquidity sweep, where the liquidity gets swept, and then we want to be a part of the move. Okay, so it's pretty simple. And then, but so you don't only have to use session ranges. We can even use liquidity like this high, for example. So if the market pushes now up to this high and we're close to this high, and let's say it's now a New York session and it grabs liquidity below and it pushes above this high, we can kind of expect also a retracement, okay, to the downside, and we can even take sells in a bullish trend. But the thing is, you need to understand again where the discount and premium zones are on the high time frame to be able to identify trades. All right, so that's the basic. Let me just undo this. I just done, and I cannot undo it. Oh, that's great. Okay, it's fine. Let me type it out again. So liquidity rate strategy. G. Okay, so the first thing is we want to identify, or we want yeah, identify or time frame bias. So we want to have a high time frame bias. That is super important. So that's going to be the first step. The second step would be then to identify liquidity pools. Okay, so that can be in the form of session ranges or failed displacements. Okay, so I'm going to go get to that point now, the failed displacements. So that's the second point. Then thirdly, wait for liquidity rate or sweep, whatever you want to call it. And then of wait for market structure shift or change of character. I guess I'm gonna market structure shift, MSS, and shock. Okay, so if I talk about these things, just know that it's the change of market structure, or it's a change of character. Okay, so remember that. Okay, so and then take entries on whatever smart money thing you want to use to take entries. I usually use the fair value gap or chock and flip, but there's different ways. So you can either take entries on order blocks, you can take entries on fair value gaps, you can take entries on breaker blocks. I'm going to go through a few examples. Breaker blocks, you can take entries on fib levels. Okay. So you can decide how you want to enter, but it's going to be on a low time frame. So and you need to be quick and you need to be at the chart with the strategy. It's not normally using limit orders. You can, but it's most often not. You're going to take market executions. Okay. So that's a strategy. All right. So let's just go through some examples. Okay. So again, we want to always start on a higher time frame. So normally the daily or the 4 hour to determine a bias, where we are going and where we should go. Okay, and I'm going to go over a trade that I actually took yesterday. That was quite nice. Okay, so we can clearly see there's an uptrend. Okay, we're creating higher highs and higher lows on the daily time frame. All right, high, low, now high. All right, so now after this high, if we just use our fib tool to identify the range, we are now in the 50%, but yesterday we were still in a premium, busy retracing to the downside. So when we are busy retracing, bearish. Okay, so bias is bearish and looking for sells at least until the 50%, or at least until fair value gap gets solved. Okay, so this fair value gap actually did get tapped today. Let me just use my. So that's also why I took sells today and not taking sells anymore. All right. So this was my actual targets for sells. So now I'm not going to sell anymore. I'm going to look for buys if we have a change of market structure on the low time frame. All right. So yesterday, it's going to go on to the 15-minute. We had a good run to the upside. But now remember, while we're running to the upside, we understand that we are actually looking for sells. So we are just waiting for liquidity to get swept before looking for sells. So where would my liquidity be? All right. Now there's a lot of different sessions in this, but once we reach the session, I actually looked for sells. Okay. The first trade that I took was above this high. So right here, and that failed. Like it did show me some sort of an entry on the low time frame, but then I took a loss, and that's fine. Okay. But then I realized, and I zoomed out and I realized, okay, but we are actually heading up further. So what liquidity are we targeting? If we already took out this range, well, this was the Asia, this was the London, this was New York, oh, this was, sorry, I'm not, let me just check. So this was Asia, this was New York, this was the next day, London, New York, Asia, London, New York, Asia. All right, so look at this big move here. So imagine above this high, how many liquidity is sitting above this high? Just imagine that, because this high never got taken out. Never, like not here. Like this high took out these highs, but then we dropped and it never got taken out. So there's massive amount of liquidity here. So if we are truly heading to the downside, and if we are truly heading to this liquidity down here, okay, we most likely are going to sweep this. And not only that, like I expected us to fall earlier, but because these trades didn't work out and this thing just ran up, this was the most obvious next liquidity pool. So I'm identifying my high time frame buyers as bearish, even though we are bullish on a daily, but we are retracing, so I'm bearish. I identified, I'm looking for sells above liquidity level, so where liquidity gets swept at. So this was the first one. So I'm going to go now to the 1 minute. Okay, so I want to show you now yesterday what happened. All right. So I'm identifying in the session. I want to look for sells. Now in the morning session, the London, we pushed up, we came above. We didn't have any sort of market structure shift, nothing happening. Okay, so we just pushed up, and then right here we got our first market structure shift, and I took entries on this fair value gap sitting here. Let me just remove this in. And I took entries here. And it did give us some sort of a reaction, but unfortunately, it didn't hold and I got taken out. Okay, so that's fine. I got taken out. But then I looked at the next level of liquidity. So even here, it didn't make sense for me to start selling here, because we didn't take out any liquidity to the left. We were still busy running up to this main liquidity level. All right. So the main liquidity level was sitting there. So what happened was we actually still in the London session came up. We ran into this liquidity zone here, and this was where the entry was. Okay, so now you need to discern how you want to take your entry. My entry for this trade specifically was a chalk and flip entry. Now, a chalk and flip is just a demand level, basically a reaction in a demand level getting taken out. So this was an order block, all right, and we had a reaction in this order block. So if we are if the market still wants to push up, it's definitely going to break this high because it's trending up. So it needs to break the previous high. Okay, high, low, high, but it didn't. So this order block, the reaction in this order block is the flip level. So if this reaction gets broken, I'm getting into the market. Now that was just my entry model for this specific trade. Okay, now I actually got quite lucky, because if I didn't use this entry model, I most likely wouldn't have gotten the entry that I did. You might have taken the entry on fair value gap. So once this thing dropped here, the fair value gap was here. Okay. So that's again market execution. So you could have entered right on this candle here as well. So it's pretty close to where I entered as well. All right, so you need to decide what entry, because a lot of times the chalk and flip is getting you a worse entry, because then there's fair value gaps and order blocks above, and the market might push down and then tap into these and then melt. So you need to decide what you want to use, and you can be consistent with it or not, but the entry model is all up to you. Okay, I can't tell you how to enter, all of that. If you tried to have a fib, there was no retracement, so you wouldn't have gotten an entry unless you maybe waited for this low. But even this there wasn't an entry yet. There might have been an entry in New York for you, but yeah. But again, this would have also been a nice chalk and flip entry down here, because this was your demand or your bullish order block. So if the market wants to push up, high, low, high, and now gets in here. If this reaction gets broken, which it did, but look at this now. So if you entered here, all right, you would have gotten quite a bad entry. So 7 pip stop. So you would have been in drawdown here. Whereas if you waited for a retracement or an order block, or even a fair value gap, if you waited for that fair value gap to form, the fair value gap basically formed right here. But again, there wasn't a market structure shift before this, so this wouldn't have been valid. So market structure shift only happened here. So yeah, it's kind of, yesterday's the market really just moved. There wasn't really too much entry space. So I got actually quite lucky with this entry, but again, I looked at the high time frame, liquidity. So yeah, and then the entry got taken right on the flip, stops above. So this was a 5.5 pip stop loss. And then my first target, obviously, is the first liquidity here, but I automatically just targeted a 1 to 5. Okay, so 1 to 5 right there, but I didn't put in my TP. I just kept that at a 1 to 5. So this was also the high of the Asian session. But then what happened was, once New York started, this thing just melted really hard. And then at